Previously on Stay in Your Lane.
We would expect to see 2 or 3 times this year. And then going into next year, you could have 4 cuts, more than that, maybe 6 cuts.
So more of a transitional year.
Yeah, I think that's right. I mean, where the inflation is starting to come under control pretty well.
So if we look at 25 as our transitional year, we're gonna see some rate cuts. You're saying on a schedule, so there'll be a plan. It won't just be off the cuff. Do you see rates getting extremely low like they maybe have been in the past 5 to 10 years?
Um,
Because I can tell you, I sit with coworkers that are younger than me, and we discussed it in the past. Many of them have never seen interest rates above the 4% mark for a 30-year note for a long period of time. And I remember the 80s when there were double digit mortgages. And the 90s, the 90s when I was young and starting out, and you know great credit was 7% for a 30
yeah,
year. The mortgage, they say mortgage rates are high, but are they really? Well, maybe compared to the past, from the past 15 years they are, but not historically.
that's exactly right. And I'm going to go back and bring up one of those charts here. Let's take a look at the chart in the middle.
Okay.
Black line being the Fed funds interest rate.
Mm-hmm.
Um, Gee, back here in the 80s when we really had serious inflation, it was 20%. Now it's at 5% or something, around 5%.
There were
Holy
car
cow.
loans and boat loans that were 14 and 18%.
That's right. I often go to speak at engagements or, industry meetings, and I say, who had an 18% mortgage? And you'd be surprised at how many people raise their hand. So there's been a generation of people that has basically never seen anything but 0% rates. And let me focus in here a little bit shorter term period. They've been living in this period where the Fed funds rate has been basically zero, except for a small period here when it went up to 2.5%.
Mm-hmm.
So up here at 5%, it feels really high. Well, compared to historically, it's been more like this: 5, 10, 12%. Historically, it's still pretty low and it's going to get lower. I don't expect it to go to zero. I thought that was a very poor policy. But, as the situation unfolds, if the economy starts to really tank, then yeah, that could happen. I wouldn't expect to see that happen anytime in the next couple of years. But
Okay.
yeah, mortgage rates, look at that, 7%, but historically, it's not that high. It's not that high. It's less than half of the peak from earlier years.
Okay. So you don't think we're not going to see, interest-free money like we saw in the past in the future? And we all know inflation at some level is just another form of tax, right? On everyone to cover. Um, what are your concerns, Dan, moving forward? What would you say is your number one concern from the economy's perspective?
Well, I'm just going to beat on this chart one more time. The black line, the Fed funds rate, let's say representative of most interest rates, was set to zero during the Great Recession and the global financial crisis. It's never been done before. After you subtract inflation, they call that the real interest rate, it was negative. Negative. That had never been done before. Wild policy experiment that I think really in the end was a failure. And I could talk about that more. But for a long time, since 2008, 2009 into the current period, almost 0% rates, negative real interest rates. think we'll look back on this and say, what were they thinking? I think it's going to come back and bite us, and maybe doing so now.
Okay.
So, what am I concerned about? I'm a little concerned about the employment market, the labor market. It needs to keep growing, but I'm seeing signs there that we're slowing a little too fast. There's this somewhat controversial measure called the SAHM rule, SAHM, that basically says, let's take a look at the unemployment rate. If the unemployment rate goes to, let's just say 3.5% to 3.7% over the course of a year, yeah, a big deal. If it goes from 3.5% to 4% over the course of 6 months, you have to ask, is that too fast? And this SAHM rule says, yeah, that's too fast. Now, what typically has happened in the past is you've got a slowdown in the economy. Let's just put it that way. And that's what is showing. The unemployment rate is rising too fast. So that's the thing that concerns me the most. Concerns a lot of other economists is, this inflation, you're cutting interest rates. We can see why, but you're running the risk. Fed is running the risk that it could restart interest rates. So restart inflation. And that's historically has happened before.
Right.
So that is a little bit of a concern as well. And of course, there's always the wild cards out there of geopolitical situations. We've seen so much develop in the past year they wouldn't have expected. And that also brings me to mention the upcoming election. Of course, everybody's focused on the presidential election,
Mm-hmm.
but the congressional election may be more important. Here's why. I think the odds now are that the Republicans will hold the Senate by like one seat, uh, you know, 51 to 49.
That's a close one.
That's close. And then over on the other side, it looks like in the House of Representatives, it's going to get flipped to the Democrats by just a few seats. So that leaves us with a divided government. No matter who is elected president, Congress is divided.
Right.
And historically, that's thought to have been a good thing for the economy because it allows Washington to do what it does best, which is nothing but spend money.
Yeah, I was gonna say, spend money. They're pretty good at that.
They're good at that, but it keeps any one party from controlling the legislative agenda. It keeps any one party from running away with things, and that check, that balance, is thought to be a really good thing again because it provides a status quo, it provides stability,
Stability.
it provides certainty. People like that, and one of the certainties is they're going to keep spending money, but we know that. So
Yeah, that goes without saying. That's not gonna. You're gonna spend. Now, I remember there was so much spent on infrastructure and so much government revenue coming from an infrastructure perspective that there were going to be all this work, and I don't know that I'm seeing that.
Um, from what I understand, this was the Infrastructure Act, the Bipartisan Infrastructure and Jobs Act, and it was to provide a lot of money to fund infrastructure projects, which we surely need. And my understanding is yes, that has provided money to those projects, but there's still a lot to be spent. It's had some good impact in the terms of it has preserved or created jobs, but again, at an expense, taxpayer expense. And I think there is more in the pipeline from that Infrastructure Act. So you haven't seen all of that money spent. Maybe that's why there's the feeling that it hasn't had the big impact that it should have. But I think it's likely to continue to be dispersed.
Wow, a lot of different moving parts, Dan.
Yeah. And the big part that we're looking at right now is what the Federal Reserve is going to do. They've been on this path of raising rates to slow the economy and cool inflation. Now they're saying, okay, we've cooled inflation just about enough, we think, and the economy is getting pretty mushy over here. So now's a good time to start cutting rates. And that's what we're going to see. That's the story that's coming up. That's the story that's going to evolve in 2 weeks from now at the next Fed meeting. And then economics in the economics world, that's the story because it's a sudden, not a sudden, it's a change in policy. And that's what we're going to be watching carefully. And also for me, the employment situation.
I think the employment thing is probably the scariest, other than the geopolitical. Where do we go from here? What's going to happen in the next 6 to 12 months? Overall, I would say globally. Then the election on top of it, and then you add the employment thing, which is closer to home here.
Yeah, absolutely.
So there's a lot going on, Dan. Thank you again for all the direction, the wisdom, and support from all of us at Triple T and Stay in Your Lane. We greatly appreciate the time you give us. We're
Thank
thankful.
you, John. Certainly appreciate your asking me.
How about Allianz? Have you seen? It seems like we've seen a lot of companies filing for bankruptcy. Can you speak to anything that you're seeing on that note?
Yeah, over the past 2 years, we have seen a pretty sharp increase in the percentage of companies filing for bankruptcy. Nationwide, I don't know, the past year was something like 40%. Well, that sounds disastrous, and we definitely saw it. We saw a huge increase in the number of bankruptcies. But it was from a very low base historically. It's like those 0% rates.
Right.
We were at a very low base to start off of. So we're actually in a pretty good state to manage that. We're well prepared for that increase in bankruptcies. And we saw it last year, and we're continuing to see it this year. We see it a lot in retail and in construction as well, which shouldn't be much of a surprise to you. And yeah, you're seeing more of it in the news all the time. And that's because of this slowly weakening economy, this economy that's getting more and more mushy under your feet all the time.
Wow. Well, it's always concerning when you see bankruptcies and filings and closings. Those people that work at all those companies are now out of a job.
That's why I say employment really is the most important thing. Who cares about that 0.2 of a GDP?
Right,
Care
or
about
a
if
quarter
you
of
have
a
a job.
percent, or you can navigate if you're employed. And you have
Exactly.
steady income.
Yep.
Wow. Thank you so much for sharing. Thanks for being on. And until next time, Dan, stay in your lane.